Hi friends, my name is Reema and I will be uploading a series of videos every alternate day completing the class 11 and 12 portions of accounting. To get notified on the new chapter, please subscribe and click on the bell icon to get the notification. Now let's get started. Chapter 1, Introduction to Accounting. This introductory chapter deals with the nature, need and scope of accounting. So what is accounting? It is the process of identifying, measuring, recording, and communicating the required information relating to the economic events of an organization to the interested user of such information. In order to appreciate the exact nature of accounting, we must understand the following relevant aspects of the definition: economic events, identification, measurement, recording, and communication, organization, interested user of information. So, economic events. An economic event is known as a happening consequences to the business organization which consist of transactions and which are measurable in monetary terms. For example, purchase of machinery, installing and keeping it ready for manufacturing is an event which comprises a number of financial transactions such as buying a machine, transportation of machine, site preparation for installation of machines, expenditure incurred on its installation and trial runs. Identification, measurement, recording and communication. Identification means determining what transactions to record, that is, to identify events which are to be recorded. It involves observing activities and selecting those events that are considered financial character and relate to the organization. Measurement means quantification, including estimates of business transactions into financial terms by using monetary unit. If an event cannot be quantified in monetary terms, it is not considered for recording in financial accounts. Recording. Once the economic events are identified and measured in financial terms, these are recorded in books of account in monetary terms and in a chronological order. Recording is done in a manner that the necessary financial information is summarized as per the well-established practice and is made available as and when required. Communication. The economic events are identified, measured, and recorded in order that the pertinent information is generated and communicated in certain form to management and to other internal and external users. Organization refers to the business enterprise, whether for profit or not for profit motive. Interested users of information. Many users need financial information in order to make important decisions. They are internal users and external users. Internal users include chief executives, financial officers, vice president, business unit managers, etc. External users include shareholders, creditors, tax authorities, regulatory agencies, etc. There are 4 characteristics of accounting information. Those are reliability, relevance, understandability, and comparability. Reliability means the user must be able to depend on the information. Relevance. To be relevant, information must be available in time, must help the prediction and feedback, must influence the decision of users. Understandability means decision makers must interpret accounting information in the same sense as it is prepared and conveyed to them. Comparability. The users of financial report should be able to compare the various aspects of an entity over different time period and with other entities. The basic objectives of accountings are maintenance of record of business transactions, calculation of profit and loss, depiction of financial position, providing accounting information to its users. Now, let's check your understanding. Which of the following is not a business transaction? A. Bought furniture of Rs 10,000 for business. B. Paid for salaries of employees Rs 5,000. C. Paid son's fee from her personal bank account Rs 20,000. D. Paid son's fee from business Rs 2,000. A tip for answering this question is to check whether it is a business transaction and can be measured in monetary terms. I hope you have an answer in your mind, and let's understand each of the transaction in detail. Buying a furniture for the business is a financial transaction. Paying salaries is again related to business and can be measured in monetary terms. Paying son's fee from a personal account has no relation to business and its bank account. So, this is not a business transaction. Paying son's fee from the business affects business cash and bank balance. Hence, it is a business transaction. So, here the right answer is C. Paid son's fee from her personal bank account Rs 20,000. Let's understand the basic and the most important terms in accounting. Entity. Entity is a reality that has a definite individual existence. Business entity means a specifically identifiable business enterprise like hypermarkets, cargo services, etc. Transaction. It is an event involving some value between two or more entities. It can be a purchase of goods, receipt of money, payment of creditor, incurring expenses, etc. It can be a cash transaction or a credit transaction. Assets. Assets are economic resources of an enterprise that can be expressed in monetary terms. Example, Cargo Services owns a fleet of trucks which can be used for shipment. Liabilities. Liabilities are the obligations or debts that an enterprise has to pay at some point in time in the future. They represent creditors' claim on the firm's asset. Capital. Amount invested by the owner in the firm is known as capital. It may be brought in cash form or in asset form. Sales. Sales are total revenues from goods or services sold or provided to customers. Sales may be in cash sales or credit sales. Revenues. These are the amounts of business earned by selling its product or providing services to customers. Example, commission, interest, dividends, royalties, rent received, etc. Revenue is also called as income. Expenses. Costs incurred by the business in the process of earning revenue are known as expenses. Generally, expenses are measured by the cost of assets consumed or service used during an accounting period. Example, depreciation, rent, wages, salaries, interest, electricity, water, etc. Expenditure. Spending money or incurring a liability for some benefit, service, or property received is called expenditure. Purchase of goods, purchase of machinery, purchase of furniture, etc. are examples of expenditure. If the benefit of expenditure is exhausted within a year, it is treated as an expense, also called as revenue expenditure. On the other hand, the benefit of an expenditure lasts for more than 1 year, it is treated as an asset, also called as capital expenditure. Profit. The excess of revenues of a period over its related expenses during an accounting year is called as profit. Profit increases the investment of an owner. Gain. It is a profit that arises from the event or transactions which are incidental to business, such as sale of fixed asset, winning a court case, appreciation in the value of an asset. Loss. The excess of expenses of a period over its related revenues is termed as loss. It decreases owner's equity. It also refers to money or cost incurred without receiving any benefit in return. Example, cash or goods lost by theft or a fire accident. It also includes loss on sale of fixed asset. Discount. Discount is a deduction in the price of goods sold. Voucher. It is a documentary evidence in support of a transaction. For example, if we buy goods for cash, we get cash memo. If we buy on credit, we get an invoice. When we make the payment, we get a receipt, and so on. Goods. It refers to the product in which the business unit is dealing. The items that are purchased for use in business are not called goods. For example, for a furniture dealer, purchase of chairs and table is termed as goods, while for others it is furniture and is treated as an asset. Similarly, for a stationery merchant, stationery is a good, whereas for others it is an item of expense. Drawings. Withdrawal of money or goods by the owner from the business for personal use is known as drawings. Drawings reduces the investment of the owner. Purchases. Purchases are the total amount of goods procured by a business on credit or on cash for the use or for sale. In a trading concern, purchases are made of merchandise for resale with or without processing. In a manufacturing concern, raw materials are purchased, processed further into finished goods, and then sold. Purchases can be made in cash or in credit. Stock. Stock or inventory is a measure of something on hand, goods, spares, or other item in the business. Debtor. Debtors are person or other entities which owe to an enterprise an amount for buying goods and services on credit. The total amount outstanding against such person or entity on the closing date is shown in the balance sheet as sundry debtor on the asset side. Creditors. Creditors are person or other entities who have to be paid by an enterprise an amount for providing the enterprise goods and services on credit. Assets are classified as non-current asset and current assets. Non-current assets are those assets that will be kept for a longer duration, usually more than 1 year period. It includes fixed assets, non-current investment, deferred tax, long-term loan and advances given to others, and other non-current assets. Fixed assets are further classified into tangible, intangible, capital work in progress, intangible assets under development. Current assets are those assets which are liquidated within a year time. It is further classified as current investments, inventories, trade receivables, cash and cash equivalent, short-term loans and advances, and other current assets. Liabilities are classified as non-current liabilities and current liabilities. Non-current liabilities are those liabilities which will take more than 1 year to settle. It is further classified into long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Current liabilities are those liabilities which will be settled within 1 year time. Current liabilities are further classified into short-term borrowings, trade payables, other current liabilities, short-term provisions. Now let's do an activity. Will you be able to classify each of these items into the correct bucket? I hope all of you were able to get the correct answer. Please cross-verify with the final answers, cells colored in green. In case of any questions or you need any help on any other accounting topics, please feel free to contact us. Please remember to subscribe to our channel so that you do not miss out on any upcoming chapters. Thank you.